Home builders are now starting to crowd the top 15 value opportunities in the tracker that the Patreons have access to. But the question is this a value opportunity or is it a value trap? That's what we're going to try to cover in this video. So guys, smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up guys, and welcome back to the channel where the goal here is to help at least 1,000 people achieve financial independence much sooner. Something interesting is happening as of late. Home builder share prices have gotten further and further beaten up in the market as the Federal Reserve continues to increase interest rates, and of course home building or home purchases have slowed. So the question is this now a time to start picking up these home builders on the cheap, or is it a value trap? I don't think there's a right or wrong answer here, and so I'm going to try to present the evidence. You guys let me know in the comments what you think. And so let's dive right into it. So you can see here, 3 of the top 15 opportunities in the tracker that the Patreons get access to are home builders. You can see that Dream Finders Homes is trading at approximately 35% of what I think their intrinsic value is. And once again, I might be wrong. I'm never perfect here. TriPoint Homes is trading at approximately 40% of their intrinsic value, and LGI Homes, my personal favorite, is trading at approximately 53% of their intrinsic value. So you can see how they're starting to crowd that top 15 investment opportunities where I gauge current share prices as a percentage of their intrinsic value. So there is a bit of clumping at the top with home builders right now, and that generally what happens with out of favor type industries. They will clump up to the top. You have consumer discretionary there, you have home builders there, you have Alibaba there, so Chinese type investments that are there too. Generally, when an industry goes out of favor, the participants in that industry will sort of clog up that top area. And so this was one that I'm seeing a glaring example of, and so I wanted to talk about it. But you'll notice the first question is, why is it that home builders are being traded so low? And in fact, they've been being traded low for a long time now. So you can see here that contrary to what the valuations might suggest, home builders are actually making money hand over fist. Note how much that the supply has actually surged. We haven't had this much new supply come on since 2010. And the problem, however, that I see is the looming issue with affordability, which is combined with the higher interest rates and a looming consumer slowdown as a result of a lack of affordability, which I will show you in the next couple of slides. This could really bring down home prices and hurt some home builders. So from my perspective, the best positioned home builders are going to be the home builders that operate in that sort of lower tier area, like that entry-level home buyer purchase area. That's where LGI Homes operates. That's where Dream Finders Homes operates as well. And TriPoint is a little bit more in the mid-market. The problem is where they operate. They operate a lot in that California market. However, they're making a concerted effort to diversify outside of California. And so that's why I like them, and they're also on my tracker. And just going back to talk about home affordability, you can see here that home affordability is nearly the worst on record as mortgage rates have spiked. Now, this is a bit of an older article, which is kind of crazy. This was only May 2nd, but the average rate has now passed 6%, I believe. Guys, correct me in the comments if I'm wrong, but I believe it has approached 6%. So the vast majority, 95% of all 100 US housing markets are now less affordable than their long-term levels. And here's an interesting point, and the reason why I wanted to show this older article. It's saying that if rates were to rise just 50 basis points more, or home prices were to increase just 5% more, home affordability would be the worst on record. Now, here's the thing. Interest rates did increase 50 basis points more, and home prices did also increase greater than 5%. So we are absolutely in a market where, because of the mortgage rates, plus the home prices, we are at the worst affordability market in history. And so what has to happen? I'm predicting that home prices are gonna start to decline. But one reason that causes me pause in that prediction, and one of the reasons why home prices continue to go up month after month after people call for home prices to decline month after month, is that we are at a record low level of inventory amount. So you can see here, America is short over 5 million homes, and builders can't make up the difference. So just putting this into perspective, this is a bit of an older article. This was in September of 2021, but some 12 million American homes were formed between January of 2012 and June of 2021, but only 7 million new single-family homes were built during that time. Single-family home construction is running at its slowest pace since 1995, although that has picked up a little bit in the recent environment. And so what I believe you have is people who are renting that are sitting on the sidelines right now, waiting for either more inventory to come on or home prices to come down. So I believe that there's a bit of a push and a pull with this market here. And so if you have lower home prices, it is better for the market as a whole. And it lends support to the fact that there's demand for an appetite for more homes to be produced. But that only makes sense if we don't have a consumer-led recession, which could potentially lead to layoffs. People are generally not buying homes at the same rates if they're worried about their jobs. So we'll see how this sort of thing plays out. But the important thing there to consider is that a lot of people are saying that home builders are going to start reducing the number of homes that they're building because they just can't continue to build more homes in this potentially recessionary environment. And I agree with you, but here's the issue. If home prices start to come down and the commodity prices have also come down, so the cost to build the home comes down too, that could lend to an argument that home builders will be relatively okay over the next 3 to 5 years. But who knows? It's very hard to predict what's going to happen in this market. But of course, you can see here, this is exactly what I'm talking about, that the home prices have just gone up too much too fast. You can see the rate at which these home prices have surged, especially post the coup. And so I do believe that there's going to be a pullback here. And I believe that the reason why we're going to get the pullback is, of course, higher rates and lower commodity prices, which brings down the cost to build those homes. But once again, if we enter into a recession and the buyers dry up, you could see that even if home prices are coming down, builders may not necessarily be able to build because the demand may not necessarily be there. Now, here's the interesting thing. There's another thing that's going on in the market right now. There's something that I said early on in this channel. I said that the work from home thing is not going away. I would think that worst case scenario, people who have been working from home will maybe go back to the office 2 or 3 days a week. So what does that really mean? It means that you can locate further away from home, or for a lot of people who are permanently work from home, they can locate out of the cities, the high price cities that they're currently in, and purchase homes in lower price cities. So there's a bit of an arbitrage happening here. And I have a really good chart to show you exactly why that's happening. But before I go into that, I just want to explain why that matters. It matters because this is a bull case for home builders who are located in metropolitan regions that are serving this sort of movement or migration of people outside of the higher price states into the lower price states. So if you look over here, you can see that this is the migration trend. So at the bottom left, you can see that New York and California were the biggest losers in post the lockdowns. And you can see on the top right, Texas and Florida were the big winners. And what are the commonalities here in terms of big winners, in terms of migration out of these states? And so what's the commonality here? Well, the commonality is that Texas and Florida, especially Florida, have just cheaper priced real estate inventories. So if you were priced out of the market when you were in New York or San Francisco or San Jose, you could move into Texas or you could move into Florida. And so even cities like Austin, which have now become more expensive, if you're priced out of the market in Austin, you can move a little bit south and go to Houston, or go a little bit more north and go into the Dallas-Fort Worth area. Or if you really don't care, you can go a little bit north into Oklahoma. So there's a lot of opportunities for people who want to relocate right now, and it doesn't impact their employment situation. So that's a real bull case for continued strength with home builders that are positioned well in this environment. So this goes back to my whole point where it's really difficult to determine whether or not this is a value trap opportunity or if this is a real investment type opportunity. I have taken the position that home builders, even the ones that I'm investing in, may experience some short-term pain, but overall, I think that they're too cheap to ignore, and so I have included them in my portfolio. But I wouldn't disagree with you if you said that it's too much risk right now. But I do want to show you one home builder that I really like. So if you see here, you can see that LGI Homes is actually one of those home builders that are positioned really well. They operate in high growth, post-COVID migration areas, which include Texas, Arizona, Florida, Georgia, and New Mexico, plus other regions. And just to put this into perspective, you can see here that I just pulled a random house out of Florida. This is a little bit out of the way. It's just a little bit removed from Tampa. I think it's about an hour or maybe 2 hours away. That's where Samira Beach is, I guess. But you can see here that this is a 2,500 square foot home, 4 bedrooms, 3 bathrooms at the current price that it's selling for. And the Zestimate is actually lower than the current price. They're saying that it'll sell for $20,000 less than what they're asking for. The estimated monthly cost of just the principal and interest for this home is $1,500 a month. That's a large home for a very affordable price. And if you compare it to a city which is deemed to be a cheap city just 2 hours west of them, that's Tampa, you can see here that the average rent in Tampa is approximately $2,500 a month as of May 14th at least. So based on these rental prices, it makes a lot of sense that if you live in the Tampa region and you're renting in the Tampa region, it makes a lot of sense to own 2 hours outside of the Tampa region and buy from a builder that offers inventory in the low 300s, which gives you a mortgage of approximately $1,500 per month. And moving into the valuation, you can see here that currently LGI Homes at a valuation of $162 per share, which is just using a terminal multiple of 10 times earnings, and I'm using a terminal discount rate of 11.5%, their price to intrinsic value is 53%, and they're trading at 4.8 times their fiscal year 2022 EPS. So that's very low. Now, the one thing that you might point out is look at that $30 penalization that I put to the valuation. Does that not mean that there could be a potential bankruptcy risk here? Because that means that the company has leverage in an environment where their revenues could be drying up. And I would say that's a very good question. So you can see here that investors that are concerned with their debt to capital, I don't think you should be concerned with it, because look at them in this environment where if I add in inventories at 50% of their book value onto the excess capital calculation, you can see that even with the assumption that they have to fire sell their inventory in sort of like a black swan event, at 50% of the book value, they still have excess capital of approximately $12 per share. So in other words, what I'm saying is, yes, they have debt, but they have so much by way of inventory that they can address that debt in a sort of like black swan type environment. And you kind of have to think about black swan type environments, especially post the mortgage crisis, which we just went through 12 or so years ago. So moving into here, you can see that this is how I'm forecasting their EPS out. Now, I don't have a crystal ball. I might be wrong here. I'm just forecasting steady as she goes growth. And of course, you guys may argue that this is wrong. Let me know in the comments below why you think it's wrong, because I'm always looking to challenge my estimates. But essentially what I'm saying is this a value trap? I don't know. Here's what I think. Although it's likely that a slowdown will occur in the housing market and in 2023 plus earnings are likely to decline, if inventory undersupply economics persist, which I think there's a possibility that they can, the next 5 years of EPS adds up to approximately $95 per share undiscounted compared to the current share price of $85 per share. So there's a substantial margin of safety on future earnings, because if they can just hold their steady as she go EPS for the next 5 years, that is more than the current share price of LGI Homes. So effectively, you're getting a substantial margin of safety here. And what if you wanted to reduce your risk even further? You guys know that I love the cash secured puts on this channel. So you can see here that with patience, you might be able to sell that $65 cash secured put for December 16th, 2022 for approximately $5.50. And you can see that the last trade on this was $6.10. However, it is outside of the current bid-ask range, but that can change quickly. So if you sell it for that, it will reflect an annualized yield of 16% and provide you with a net purchase price of $59.50 per share, and if you are exercised. So that reflects a forward PE ratio, not of 4.8 times earnings, which is what the current share price is reflecting. It reflects a forward PE ratio of 3.5 times earnings. So instead of paying $90 per share for LGI Homes, you could enter into a cash secured put opportunity where you enable a win-win situation where you either get a 16% annualized yield, or you end up purchasing this company for 3.5 times forward 2022 earnings. So that gives you a substantial margin of safety. So even if the earnings decline by 50%, you still have purchased this company at 7 times earnings. huge deal here in my opinion. And you can see from here, this is something that the Patreons get access to. This is what I call the cash secured put analysis tool. You can input the strike date, the put price, the premium, and you'll get the calculation of what the annual yield would be, what the net purchase price would be of the company. So obviously if you're entering in a $5 premium, you get a 16% annualized put yield, and so your forward P is 3.4 and your reverse PE yield is 30% if the company maintains their current profit. So you get access to that at the lower tier of the Patreons. And so like I say, if you want access to all of the model information on all of these companies and the tracker, you can get access to that at the lower tier of the Patreon. And like I always say, there's no risk to you, because if you decide to try out the Patreon and you decide that it's not for you, don't just cancel. Message me in the app, let me know that was not for you, and I'll completely refund your first month's subscription value, because that's how much I believe in the product. Now, the other thing that you guys got to be aware of is that I think that there's more evidence that Ant Group is going to initiate an IPO sooner than we think, and that could be a real catalyst for Alibaba shares. So if you haven't seen that video, you can get to that video right here.